Thank you for joining in again today. This is KK from TK Financial Group. Today we're going to be speaking about corporate life insurance. And if you own corporate life insurance, you need to hear this. Corporate life insurance is just like owning life insurance, but you would purchase it within a corporation. So it provides you a couple of benefits. It can pay for taxes that are owed by the corporation upon your death. And it also provides an investment too as well within the corporation, and it can grow tax-free. And you can also borrow your funds from the life insurance to the business too as well. So if you own corporate life insurance, like permanent insurance, also called PAR or participating insurance, you need to hear this. If you have dealt with a life insurance salesperson and not a professional, this is what they've told you. You can purchase corporate life insurance and your corporation will pay for it, and you can write off the amount. If you pass away, all the insurance funds will go through something called a CDA account. That's a capital dividend account, tax-free. Now I'm going to tell you, both these statements are false, and I'm going to show you how. I'm going to take you to the board today, so let me switch around right now. So firstly, corporations can't expense the entire amount. The government does not consider life insurance an expense. So you need to pay corporate taxes first, and then you can expense it. So basically, you have your corporation. What people want you to believe is that the life insurance is in there. And this is false. So what you need to do is that you have your corporation, you pay your taxes, and then you pay for your life insurance. I hope that makes sense, because you cannot write off the whole amount. That is completely false. So here's an example. If you have a personal policy and you're paying $500 per month, what do you think that's going to cost you when your tax rate is 48%? Simple calculation, okay? So you take 500 over 1 minus the 0.48, and that'll give you $962. Now that's if you're paying for it personally. So let's say you own it through a corporation. So the corporation tax rate is 12%. So instead you pay $500 a month at a 12% rate. So basically you do 500 over 1 minus 0.12, and that would give you $568. So that's not a bad thing. So if you look at that and you look at the savings between the two, so if you're taking the 962 that we calculated there, and then we take the 568 we calculated there, so that'll actually give you $394 in savings. So is it worth it to go through personal, or is it worth it to go through your corporation? Definitely your corporation. So no matter what, you're still getting a benefit from the corporate amount. Okay, so the second false thing they told you, the whole amount will go through the CDA account. Now that all depends. The death benefit received by the corporation of an insured less the adjusted cost base, which is the ACB, of that life insurance. So that's added to the CDA account and is taken out tax-free. Any amount above this will be received as a taxable dividend. So don't believe that the whole amount will go through the CDA account tax-free. This is why a salesperson tells you that the whole amount will go through the CDA account, because it's too complicated to explain for them. Now I forgot one more thing. Like always, the fine print that they won't tell you. Unlike personal life insurance is creditor proof. Corporate life insurance is not creditor proof. So if you're sued, the vendor can't have access to the cash value of corporate life insurance and the payments if the payments are made to the corporation upon death. So again, just food for thought. So if you found this video informative, please share it, like it, follow me on YouTube, find out more about risk management. If you have any questions, please email me. My email is below. This is KK signing out. Till next time. Take care.